Welcome back to Curious Commerce. The topic cash flow statement, part 4. In this session, we will discuss about reasons for difference between cash and profit, cash flow activities, and operating activities. Your business shows profit of rupees 1 lakh, but your bank balance is only rupees 5,000. Where did the money go? The answer lies in understanding why profit and cash are different. There are five main reasons why profit and cash differ. They are credit sales, depreciation, outstanding expenses, prepaid expenses, and non-operating income and expenses. Let's understand each one simply. First one is credit sales. This is the most common reason. You sell goods today, customer promises to pay after 2 months or 3 months. In accounting, sale recorded, right? Automatically profit increases. But in reality, no cash received, no profit rises, but cash does not rise. That's why businesses suffer from cash shortage even with good sales. Second reason is the depreciation. Depreciation is an expense in books, but no cash is actually paid. For example, machine value is rupees 1 lakh. Depreciation charged rupees 10,000 per year. Profit reduces by rupees 10,000, but cash remains unchanged. So profit looks lower, but cash is higher. The third reason is outstanding expenses. There are expenses that are recorded but not yet paid. For example, salary expense rupees 20,000 recorded, but salary not paid till next month. It leads to profit decreases, but cash is still with business. Again, profit and cash differs. The fourth one is prepaid expenses. There are expenses paid in advance. For example, rent paid rupees 20,000 for 3 months in advance. Cash goes out immediately, right? But expense is recorded slowly. So, cash decreases, but profit does not decrease fully now. Difference created. The fifth one is non-operating income and expenses. They are not related to main business. For example, profit on sale of land, loss on sale of machinery, interest received, and penalty paid. These affect the profit, but actual cash movement may differ in timing. So again, profit is not equals to cash. So remember clearly, credit sales increase profit, not cash. Depreciation reduces profit, not cash. Outstanding expenses reduce profit, not cash. Prepaid expenses reduce cash, not profit. Non operating items confuse profit versus cash. Profit is what you see. Profit is what you see. Cash is what you feel. Profit is what you see. Cash is what you feel. Where does a company's cash really move? Daily businesses, buying assets, or taking loans? The answer is inside the three activities of cash flow statement. Today, let us understand the overview clearly. Cash flows are classified into three activities, namely operating activities, investing activities, and financing activities. This classification helps us to understand how and why cash is moving in a business. Operating activities are related to the main business operations. For example, a school collects fees, that is operating inflow. A shop pays rent, that is operating outflow. This shows whether the core business is healthy. A good business must generate positive cash flow from operating activities. The investing activity related to buying and selling long term assets. This shows whether the company is expanding or shrinking. Third one is financing activities. Financing activities relate to raising and repaying capital. This shows the company's financial structure and stability. So remember this logic. Operating activities means day to day business. Investing activities means activities related to assets and growth. Financing activities related to capital and loans. If you understand these three activities, you understand the entire cash flow statement structure. Imagine a business that buys land, takes loans, and sells shares, but cannot generate cash from its main business. Will that business survive? No. That's why operating activities are the heart of cash flow statements. Operating activities refers to the main revenue generating activities of a business. In simple words, these are activities related to the core business work done every day. Without operating activities, there is no real business. Main revenue generating activity means every business has a core purpose. For example, a shop, the core purpose is selling goods. A school's core purpose is to teach. Apart from that, in the point of accounts collecting fees, a hospital treating patient is the core purpose. And the same way, what about the cash flows? A factory, a manufacturing the product, that is the core activity. The cash earned from these main activities is called cash flow from operating activities. This shows the real strength of the business. Related to the day to day business operations, operating activities include daily transactions like cash inflow and cash outflows. Cash inflow includes cash sales, collection from customers, fees received, and service income. On the same way, cash outflow includes payment to suppliers, salary paid, rent paid, electricity bill, internet bill, office expenses, etc. These happen every day, every week, every month. That's why we say operating activity means day to day business operations. Cash flow from core business. This point is extremely important. Operating cash flow tells us, is the main business generating cash? Is the business self sustainable? Or is it surviving only on loans? For example, company A earns the profit of rupees 5 lakh. Operating cash flow is 4.5 lakh. Very healthy business, right? If a company B earns the profit of rupees 5 lakh, operating cash flow is negative 1 lakh. That is dangerous business, right? So always remember, a strong businesses must generate positive cash flow from operation activities. Operating activities are main revenue generation activities. They are related to daily business operations. They show cash flow from core businesses. If operating cash flow is strong, the business has a strong future. Thank you for watching Curious Commerce. Follow our WhatsApp channel Curious Commerce Financial Management Hub for daily finance learning. Please like, share and subscribe. The topic cash flow management will be continued in part 5.